Good morning, everyone. Hope you're all doing well. You're all healthy and happy. I saw the grades on McGraw-Hill for your quizzes, so you have that information. In case it's not available, I know a few of you emailed me. In case that information is not available to you for some reason, just please keep in mind I'll post the grades on Blackboard Connect tonight. Okay. Remember also that we are going to be having our midterm next Thursday, our second midterm. Which is going to be on 11/19. Okay, and it is going to cover Appendix C through Chapter 16. Again, please keep in mind that if for some reason you are unable to take the midterm, you must have a doctor's note. Okay, I want to be fair to everyone. There'll be 30 multiple choice questions, same format. Some will be calculation, some will be theory based, and you will have an hour and a half to complete those questions. Joshua, I saw my grade, but it is any way to access the quiz. All you see is a score. Okay, I'll check on that again. Okay, because you should have had access. I changed the setting for that. So thank you for letting me know. I will take a look at that early evening because I'm teaching through the early evening. Okay, thank you for reminding me. You're welcome. All right, so remember that, actually, I know on CUNY First, the date of the final is listed there. The date listed there will be the time that we'll be having our final exam again, and the final exam is going to be on McGraw-Hill Connect as well. Okay. All right. So, So we were talking in this chapter. We were dealing with manufacturing operations. Okay, and that changed the way we were recording accounting information. That changed the general ledger accounts, the format of the financial statements. Some of the key things that we've learned so far, all right, is that we were talking about product costs, okay, in the manufacturing cycle for a manufacturer. When we're talking about product costs, okay, remember those product costs are going to be direct materials, direct labor, and manufacturing overhead. Okay, so the three product costs are going to be direct labor, direct material, and manufacturing overhead. Okay, those costs flow from the inventory accounts. Okay, and then they're going only when they are sold or when the goods are sold. We have some good examples of that coming up. Only when the goods are sold, the inventory, do the cost of that inventory then flow through to the cost of goods sold on the income statement. Okay, remember that in order to be a product cost, the cost must be incurred in the factory. Okay, so that's going to be any direct labor costs, any direct material, and any manufacturing costs in the actual factory. Okay. In addition, okay, to product costs, remember that we still have period costs. Okay, period costs are any selling and administrative costs, and they are going to be deducted on the income statement after, okay, the gross profit subtotal. Okay, so keep that in mind. Any selling, administrative expenses, etc., they're still expenses. They just do not flow through the inventory account or the cost of goods sold. They're classified as separate operating expenses on the income statement. Okay. And here we see that happening. Only the merchandise inventory is going to be, those costs flow through to the cost of goods sold. Then we have the gross profit, which is the result of net sales minus the cost of goods sold. And then we have any support expenses, any administrative expenses. And again, it's going to be significant expenses such as the chairman's salary, travel and entertainment, selling and administrative. It's going to be a substantial amount of costs are not considered product costs, but they are period costs. Again, because they have, even though it's a chairman's salary, they have no future value, okay, in terms of they're going to be charged against the current time period or charged against income in the current time period. So they are considered period costs. Okay. And we talked a little bit about what happens when a manufacturer decides to be, or a merchandiser decides to be fraudulent, and when they capitalize some of those operating costs. Okay, they capitalize them in the inventory accounts. I showed you an example how that increases the inventory accounts artificially, so the assets are too high. Okay, and then also what happens when you're not deducting operating expenses in the current time period from revenue, that is, you're capitalizing them. What happens is that your expenses are too low, okay, and therefore your net income is too high. All right, so capitalizing those selling and administrative costs and not charging them against income in the time period that is warranted results in a financial misstatement of the financial statements. Okay, and again, that's something that CPAs look for, and that's what happened actually with Enron and Tyco, some of those companies, those huge bankruptcies. Okay, because what happened when they finally they ran out of cash. They didn't have any cash, then, well, maybe we'll sell off some of our assets to fund our operations. Again, if the assets that are listed are not real assets, the expenses like the chairman's salary, apartment expenses, apartment rental expenses, those aren't real assets. You can't sell them. So that's why it ended up with these huge bankruptcies, okay, because the corporations couldn't even sell any of their assets that they recorded on their balance sheet. Okay. All right, another interesting problem. So everybody, please pay attention here. Okay, so again, this is the whole matching principle, going back to that. Okay, so here, consider there's a real estate developer. Okay, and a real estate developer basically it manufactures 10 homes in May, okay, of the current year. So they put in the direct labor costs, the direct labor costs, the direct material costs, and the overhead costs. Okay, for the construction equals a total of $1 million in the current year. Okay, all right, but by the end of December, okay, none of the houses have actually been sold. Okay, that means they're all still sitting as inventory on the balance sheet, right? Those 10 homes that were constructed. So how much of the $1 million in construction costs, okay, in the current year is going to appear in the developer's income statement? And the answer is, okay, the answer is none, okay, because of the fact that they built the houses, they've incurred product costs, okay, but they don't have any revenues because they haven't sold any of the homes. So none of those costs for the construction are going to appear as cost of goods sold. Okay, what you would see on the income statement, you would just see the operating expenses being deducted. Okay, so the costs related to any revenue earned by the developer, here again, what's going to have to happen, you're going to see the inventory account maintaining the $1 million balance, and it's only when the homes are sold that you're actually going to see any expenses. Okay, and because that's the time then when they're sold, that's when the developer will see revenues on their income statement as well. Okay, so very important point. It's not intuitive. If you think, well, it's an expense for this year, I built the houses, I'm waiting to sell them. Doesn't matter. You don't have revenues because you didn't sell them, so therefore you cannot charge any expenses against the income statement. Okay, so very important point. Okay, So remember, okay, another very important point when we're looking at the books and records of a manufacturer, again, how many inventory accounts does a manufacturer have on their balance sheet? Who remembers? 3. Excellent, Daniel, Christian, Joshua, excellent. Three inventory accounts are going to appear on a manufacturer's balance sheet. First, you have the materials inventory, which are the raw materials on hand and available for use. Okay, so when the raw materials are purchased, there's a debit to raw materials and then a credit to accounts payable. Okay, the second inventory account is the work in process inventory account. Okay, so again, as direct materials and direct labor and manufacturing overhead are applied to production, okay, they're going to be units of whatever is being manufactured in various states of completion. Okay, those units which are not fully completed but have some costs assigned to them, okay, are going to be recorded in the work in process inventory account. Okay, so you have to account for those two different stages, the raw materials and the work in process separately. Okay, and then the third inventory account, which is the one we were used to really when we dealt with merchandisers, financial statements, it's the finished goods inventory account. Okay, so once all the units have been completed, okay, they can't stay in work in progress because no more costs are going to be assigned to them. They're going to be transferred to the work in process inventory. Okay, and remember, okay, from Accounting 101, when you have these 3 different inventory accounts, remember those are 3 different general ledger accounts also, right? And you're going to actually see journal entries of the flow of these costs through the 3 different steps, okay, of the 3 different steps of completion and on the balance sheet account, okay? And then, and only then, when those goods are sold, okay, that's when you're going to see the finished goods inventory being decreased, okay, with a journal entry, and then those the cost of those goods being transferred to the cost of goods sold. Okay, so it makes sense in a little while when we look at the financial statements of a manufacturer, we're going to see the journal entries are different. Okay, and at year end, even if they use a perpetual inventory method, the way that cost of goods sold has to be determined is the accountant is going to have to prepare certain schedules to determine the cost of goods sold, okay, based on the changes in these 3 inventory accounts. Okay, is one of the 3 inventory accounts more popularly seen than the other? No, because they're all these 3 inventory accounts for a manufacturer, Joshua, that's just the flow of the cost through the books and records, through the general ledger accounts. Okay, but okay, so it's not really that it's popular. Which one is probably going to be have the most dollar value? Probably the finished goods. Okay, or maybe the work in process. Maybe if you're going to have, let's say, you're like a toy store, okay, and you're a toy manufacturer, probably right before your peak season, okay, you're going to have a large inventory in your work in progress inventory account, right? Because you know you're going to have a busy season coming up, a busy season of sales, so your work in process inventory account would be higher. Okay, and if you're going through a lower period of, let's say, sales and you're a manufacturer, typically you know that your finished goods inventory will probably be less, all right, because you're not, if it's a slower season, you're not going to want to have a huge inventory of finished goods on hand because you know that they're not going to be used. They're just going to sit in the warehouse until you have some sales or some movement. Okay, so they're all used, and it's just the logical flow of the costs. Okay, remember though, okay, and this is a good question, which costs are charged to the work in process account? Okay, which costs are charged to the work in process? We know that when materials are put into production, we know that direct material costs are charged to the work in process, right? as these direct materials are put into the manufacturing process. What other costs are going to be charged to the work in process inventory account? Okay, direct materials. What are the other product costs? Excellent, Francisco. Okay, and when we're talking about labor in manufacturing, remember we're always going to differentiate between direct labor and indirect labor. So here we'll say direct labor. Okay, very good. And then what is the third and the last type of product cost that is going to flow and be charged to the work in process? Who remembers? Direct labor, direct materials, and what's the big pool account? Which basically all miscellaneous charges that are basically incurred in the factory. The most difficult product cost to manage. Come on, guys, you remember. Overhead, very good, Kristen. And manufacturing overhead, excellent. I'm sorry, not management overhead, manufacturing overhead, very good. Okay, so when we start going through the journal entries, we'll see that these three expenses, they're going to be debited to the work in process account and increase the work in process inventory because they're being applied throughout the manufacturing cycle. Okay. Okay. So here, okay, this we went over last time, the production cost flow. And I'm just going to just give a brief review of this because in a few minutes we're actually going to go through the journal entries. So it becomes even clearer to you how this process actually flows through the books and records and the manufacturing cycle. Okay, remember when we talk about direct labor costs and direct material costs added together. Okay, remember direct labor costs plus direct material costs. Okay, and then here I'm going to give you some possible points for your midterm. The formula of, and again, we use this for analysis of cost. If we add direct labor plus direct materials, who remembers what that what those two costs added together equal? Direct materials plus direct labor equal, guys, I'm trying to keep you awake. Direct labor, excellent, Francisco. So prime costs, excellent. Excellent. And then when we add direct labor, okay, these are definitions, cough, cough, okay. Direct labor plus manufacturing overhead. Direct labor plus manufacturing overhead. Christian, excellent conversion costs, very good. Direct labor plus manufacturing overhead, excellent. Equals conversion costs. And again, we have these formulas just for analysis purposes. So if you're the plant manager, if you're in charge of production, these would how you would do some analyses of these costs. Okay, to figure out, okay, how do they compare to what last year's costs were? How do they compare on a per unit basis? Okay, to last quarter. What are our conversion costs per unit this quarter versus last quarter, etc. Okay, so two important definitions. Remember, you can't add prime costs plus conversion costs. That's not a meaningful equation because we see that direct labor is added in both. Okay. So very new area that we're looking at when we're looking at the manufacturer's books and records. Okay, so here. Now we're going to look at some actual journal entries and the actual flow of costs. Okay, so here, to illustrate, here we're going to look at the financial statements of a bicycle manufacturer. Okay, and again, who cares? Who wants to look at the financial statements of the manufacturer? Who wants to look at the productivity reports, at the flow of cost between the three different inventory accounts? or why are you doing it? Again, to monitor efficiency. Remember that in a global environment, your competitors are trying to increase quality and also decrease cost per unit continuously. That's the only way you're going to stay in business. Okay, so you have to keep that in mind. Also, you want to set prices. Okay, again, you can't higher price than your competition for the same goods, because why? Who's going to buy your product? Okay, they can buy the identical quality product or higher quality product from somebody else. They're going to go with your competition. And also to maintain control over your inventories. Now, in the past, interesting story, in the past, okay, what's happened in the United States is in the United States, typically manufacturers and merchandisers were in the habit of maintaining huge inventories on hand. Okay, so again, you would ship the goods, your supplier, or you would manufacture large amounts of inventory, and then they would sit in your finished goods inventory warehouse for extended periods of time. But you never, whenever you had a sale, you know that your customer, there was inventory for your customer. Now, again, a few years ago, it happened to me when I went into an Apple store for the first time. I wanted to buy a watch for my husband. So I went to buy a watch, and I ordered the watch, the color I wanted, you know, all the specific attributes that I wanted. And then they said, okay, well, we'll ship it to you in a week. And I said, wait a minute, what do you mean? I thought I could, you know, walk out. I'm used to going in the store, you walk out with your product. And they said, oh, no, we don't even manufacture it. Apple and other really efficient, successful companies no longer have those big piles of inventory sitting around. Okay, so when somebody finally comes in, okay, can we find this color, this type, you know, this band, whatever. It's only when the customer actually orders the unit. That's when it starts being manufactured. Okay, so again, and why are they doing that? They knew that if you keep large stores of inventory, okay, what happens to large storages of inventory? They can get damaged. They can get they can be stolen. They can be destroyed. Okay, so again, and it's much more efficient. Remember, if you have a big warehouse, and that warehouse is storing all of your goods, okay, really that warehouse doesn't add anything to your flow of cost. Okay, it's only a cost. It doesn't add any value. Okay, so you're sinking costs in these huge inventories. And what happens, okay, so let's go back to Apple. What happens when you have an Apple Watch, okay, and you have Apple has a whole warehouse filled with Apple Watches ready to go in their inventory? What happens when Apple comes out with the next version of their watch? What happens to all the old Apple Watches that are sitting in the warehouse? Okay, when Apple comes out with it, exactly, it decreases in value, and it can become almost valueless, because everybody wants the newest phone, they want the newest watch. Okay, and actually, if you think places like TJ Maxx or TJ Maxx, Filene's Basement, fashion is the same way. Okay, once that season is over, okay, the stores, you know, the big manufacturers, retailers, they couldn't keep their old inventory. They have to move their old inventory. That's last season's. So especially in electronics and the fashion industries, they were getting killed with costs, okay, for their lost inventory. In fact, stores like TJ Maxx, Filene's Basement actually came into existence because of inventory inefficiencies by retailers, right? They manufactured too much. They overestimated what they thought their demand was. Okay, so now they have to sell to a discount type of operation, and they're going to lose money on it. Okay, so again, now in the with the advancement of more efficient accounting systems, technology, etc., remember, a lot of manufacturers are not maintaining large inventories. Okay, but what does it mean if you're not going to maintain large inventories of finished goods? You better make sure that your manufacturing process and your suppliers are efficient, okay, so that they know as soon as they get that order from you, okay, they're able to put together that Apple Watch, and they're going to be able to send it to me, the consumer, within a few days. Okay, but again, it's found that that's cheaper. Okay, doing your manufacturing and your inventory is cheaper doing it that way okay, rather than keeping that huge warehouse of finished goods, which is basically going to become obsolete. Okay, so really, really interesting the way things are changing. Oh, actually, I know these are real volatile times. I'd like to spend a few minutes with you just on what's happening in the financial world, the real financial world. So remember last time we met, Apple stock was selling at $114.45. We saw a bit of a dip. Okay, now today, as of just a few moments ago, I saw Apple, again, it went up about $5 per share. Okay, because there's some optimism now. Biden is picking his cabinet. I mean, he's going forward, you know, assuming that he's going to be president. So it seems to be more stability also in the workplace. So a share of stock went up to $119.83. Okay, so again, we're seeing this volatility. Again, we're just doing this for analysis purposes. I'm not telling you, okay, go run out and buy Apple stock or any other stock. But remember what I said last time, when we have a vaccine now, right, in this country, hopefully. Okay, so hopefully there's going to be an end to this, okay? Remember that industries are going to be different. Okay, so you have to be on top of what's happening in the world if you want a job, okay, in your when you graduate. All right, so you have to constantly be aware of what's going on, new industries that may be developed. Okay, we're not going to go back to everybody sitting in their offices again, you know, commuting into their office, sitting in this, you know, in an office in New York City, then commuting home. The world has changed. Okay, make sure that you're aware of what some of those changes are and what you find interesting. Okay, so that one day you could pick a field that you're interested in. Okay, so it's to your best interest. Okay, so now again, we're looking at a manufacturer. Okay, so now we're going to go through some of the journal entries. Yes, you need to you need to understand the journal entries and the flow. Okay, so now you remember Accounting 101. These are the general ledger or the T accounts. Okay, remember that I have been stating that there are three for a manufacturer. There are typically three separate inventory accounts that appear on their balance sheet. So here we have the materials inventory, the work in process inventory, and the finished goods inventory. So we're going to take a look now at the flow of cost through those inventory accounts. Okay, and again, it's not difficult. Just realize that if you have a manufacturer who's been in business for a while, okay, here this is manufacturing, the summary of manufacturing cost for the year ended December 31st, 2018. Realize that when you have inventory accounts, typically any of the inventory accounts that you have for a manufacturer are always going to start with an opening balance. Okay, and again, the opening balance for this year in these three inventory accounts, of course, comes from the closing balance in these accounts last year. Okay, so what happened to the materials inventory account? Okay, what happened over the course of this year? Again, materials inventory, there were $25,000 worth of materials inventory, of direct materials inventory at the beginning of the year. What was the journal entries over the course of the year? Purchases of direct materials. So what was the journal entry when this corporation, Conquest, purchased direct materials? You know, it would just be a journal entry to the direct materials account for $145,000. That's the amount of the purchases over the course of the year. And then there would be a credit to the accounts payable. Okay, for $145,000 as well. Okay, that's how the direct materials inventory account increased this year. Okay, but now, so they purchased those direct materials, but what else happened? Okay, we know that those direct materials are not purchased just to hold on to them. Those direct materials are going to be placed into production. So when the direct materials are placed into production, again, it's for $150,000. Okay, what is that journal entry going to be? It's going to be a debit to the work in process, and again, it's always abbreviated WIP or work in process. The work in process account is going to be debited for the $150,000. Okay, dollars worth of direct materials placed into production, and which account is going to be credited then when direct materials are taken out of or are placed into production? Which account is going to be credited here? Anyone? Debit work in process, that's what we see here. Work in process for the direct materials is debited. Very good, Casey. Direct materials, okay, is going to be credited. That's exactly right. Because we're decreasing the direct materials, okay, for the amount that was transferred out. Excellent. Okay, and it's going to be debited for, I'm just going to write it here so it's not overwriting the flow chart. Okay, and that's the second journal entry. Okay, so direct materials get transferred into the work in process inventory account, but remember, so do the other two product costs. All right, so now this is the general ledger for direct labor. Okay, so as direct labor is incurred on the payroll, okay, each payroll period, okay, direct labor is going to be debited, okay, to the direct labor account. Okay, but remember, direct labor is a product cost. Okay, so here, and remember, direct labor is not inventoriable. All right, so when direct labor, okay, those costs are applied to the work in process inventory. Here we see it for 300,000. What is that journal entry going to be? Okay, here when direct labor is applied to production, you're going to see a debit to direct labor, okay, for the 300,000. Okay, direct labor for 300,000. Actually, it's not a debit to direct labor. What is it? It's a credit to direct labor for 300,000. All right, and what's the debit to? Okay, when I'm applying, excellent, Casey, very good. Okay, and here we're going to debit the work in process. Very good for the 300,000. Excellent. Okay, so we're just tracking the costs through the application of these costs to the overhead account. All right, so remember, direct labor, direct materials, and of course, manufacturing overhead are going to be applied, okay, to the work in process inventory. Okay, excellent. All right, and again, remember, on per the payroll, you know, as everybody completes their time cards, our employees have been paid for $292,000 worth of labor. Okay, but how much labor has been applied to production? Okay, and as we look here, $300,000 of direct labor has been applied to production. Okay, so what does that mean? That means that we have $8,000 in as a credit balance in our direct labor account. Okay, so now you could be asking yourself, wait a minute, how is it possible that I have a credit balance in my direct labor expense account? Okay, how can I have a credit balance in an expense account? And the answer is because remember, the direct labor account gets debited based on every pay cycle. Okay, so every time there's a payroll, that's when the direct labor account will be debited and cash credited. Okay, remember that when direct labor is credited, which we're doing here, okay, when direct labor is credited, all we're doing is applying the direct labor to the work in process. So what happens here? After the next payroll cycle, okay, when you debit the expenses are again going to be increased, okay, and then you're going to have a debit balance in the direct labor payroll. Okay, it just so happens that they're applying direct labor to their production. Okay, remember, employees are working continuously over the year. Okay, but this is just like the adjusting journal entry at month end. Okay, when you're accruing labor expense, okay, or accruing wages payable, it's just that you haven't paid them yet. You're not going to pay them until the next payday. Okay, so here it is possible, okay, this is a good question. It is possible to have a credit balance in the direct labor account. And all that means is that you're going to see a wages payable, okay, on the balance sheet at the end of this year. You're going to have a wages payable balance of $8,000 on the balance sheet. Okay, because of the fact that these employees have worked, you've accrued their expense. It's just that they haven't been paid yet. Okay, all right. So it's always a trick question. All right. So now we've gone through where we get the information that gets debited to work in process for direct materials and direct labor. The last one is just manufacturing overhead, right? The three products costs. All right, so here now, manufacturing overhead. Again, what makes up manufacturing overhead? Okay, what type of accounts make up manufacturing overhead? Again, it's going to be things like indirect labor, rent, or rent for the excellent Kristen, rent for the factory, utilities, and remember, for the factory, other overhead costs. So indirect labor, indirect material, again, incurred in a factory setting, okay, rent for the factory, depreciation for the factory, okay, all of those costs are debited to manufacturing overhead. So the way I want you to think about it, and we're going to talk about this more in the next chapter, but when manufacturing overhead is debited, it's always for the actual costs, just like the direct labor. Okay, remember, for the product cost, actual costs are always debited. Okay, and then remember, when the costs are applied to inventory, that's when you're going to credit both the direct labor account and the manufacturing overhead account. Okay. So the actual costs are always going to be debited. When those costs are applied to your production, that's when they get credited. So here, whatever basis this company uses, they decided over the course of this year that they're going to transfer $360,000 of overhead costs to the work in process inventory. All right. So again, what is that journal entry going to be? Okay, work in process inventory, again, is going to be debited for the $360,000 of of manufacturing overhead costs that are being applied. Again, I always can get it here. Okay, I'm always going to get it from the general ledger change, and then which account is going to be debited. Again, work in process is being credited here. Work in process is being debited, excuse me. Okay, and we see that here. A debit to work in process, and which account is going to be credited? The manufacturing overhead. So we're reducing the product cost, the manufacturing overhead. Okay, and what are we doing? We're transferring those costs to the work in process inventory. Okay, so these three product costs are always, again, the actual costs incurred get debited to these three accounts. Then as these costs are applied to production, okay, you see a credit to these three product cost accounts and a debit to the work in process inventory. Okay, now remember, the work in process inventory account started with a balance of $30,000 at the beginning of this year. That's how much inventory was being worked on from last year. It was in various stages of completion. Okay, now we know through our journal entries that we increased our work in process inventory account by $300,000 for direct labor, and we see that here. By $150,000 for direct materials placed into production, and by $360,000 in manufacturing overhead. Okay, so now we're going to add these together. Okay, but what else are we told? From these journal entries, what else can we tell? We can tell that $800,000 worth of work in progress inventory was transferred to the finished goods inventory, right? Okay, so we take all of these costs, the beginning balance of inventory, direct materials used this year, direct labor used this year, applied overhead this year. Okay, then we're going to look at how much of the finished goods were actually, how much of the work in process was actually completed. All right, so what is the journal entry here when goods are completed? And we're going to reduce the work in process account, and we're going to transfer those finished goods, the cost of those finished goods, to the finished inventory account. Okay, here the 800,000 and the 800,000. Okay, what is the debit for that journal entry? Do it here. What is the debit for the journal entry when finished goods are transferred to the finished goods inventory from the work in process? Okay, here we see we are going to debit the finished goods inventory account. Okay, we are going to debit it for the 800,000. Okay, and again, we see that right here. Okay, again, once the goods are finished, we're not going to keep them in the work in process inventory. Once they're completed, we're going to transfer the cost of all of those finished units to the finished goods inventory. So we're going to debit the finished goods inventory, and then what are we going to credit? Again, we have to credit the previous inventory account, which was the work in process inventory account. Okay, because once goods are completed, we're not going to keep them in the work in process inventory account. We have to transfer all the related costs. Okay, so that's the journal entry. Everybody see? Okay, so now the work in process inventory account, again, there was $800,000 worth of goods transferred in this year. Okay, and we also know that they started with a balance, okay, of the finished goods inventory at the beginning of this year, which was carried forward from last year. And Casey, when I add the direct materials, labor, overhead, it came out to be 800. When I added the direct materials, labor, overhead, it came out to be 810,000. Oh, here, yes, okay. But remember, and that's in the work in process inventory, right? But also always remember, what did I say? Remember that in each of the three inventory accounts, remember you're always going to start, okay, you're always going to start with an opening balance as well. Okay, so you always have to add the opening balance in that inventory account, plus all the costs that were transferred in, okay, over this year. Then subtract out what the costs that were transferred out for the finished goods here for the work in process. So what's the ending balance for the work in process inventory account? Okay, good question. That's fine. $40,000. Okay, and good. That's an easy mistake to make, Casey. I'm glad you mentioned it. Okay, now for the finished goods inventory, remember it's an inventory account. So an inventory account for a manufacturer who's been up and running for a while is always going to have an opening balance. So for the finished goods inventory, we're told that they began the year already with $150,000 worth of finished goods. Okay, what else did they do? They transferred in $800,000 from the work in process inventory account. Okay, they completed $800,000 worth of manufacturing this year. So it comes out of work in process and gets debited to finished goods. Okay, so $950,000 worth of finished goods were transferred in, or we began the year with $150,000 worth of finished goods. $800,000 of finished goods were transferred in. So that's a total of $950,000 worth of finished goods. But, okay, what are we told here in this last step? We know that the company sold $782,000 worth of finished goods inventory. Okay, and remember, only when those goods are sold, that's when those goods, the cost of those goods can be transferred to the income statement or cost of goods sold. Okay, so here we had an opening balance of finished goods, 150,000. We transferred in $800,000 worth of finished goods for this year, but we sold $782,000 worth, which we're going to credit. So what's the ending balance for the finished goods inventory at the end of this year? $168,000. Okay. And then finally, here, what's the last journal entry? Okay, when the finished goods have been sold. Okay, and we could just hear, you're just putting it here, you're just working backwards from the general ledger, okay, to the journal entry. So here, when the goods are finally sold, the corporation is going to debit cost of goods sold for the $782,000. And then which account is going to be credited? Anyone? Which account, when the goods are sold, we're going to debit the cost of goods sold, the income statement account? And which account is going to be credited for the cost of the goods sold? Excellent. Finished goods, Casey. Very good. The finished goods inventory. Excellent. Okay, so that's just really giving you an overview of the flow of cost through the inventory cycle. Will also information be provided to us with the breakdown, what you would be given. So let me just finish my thought then. So here, this last step, the 782,000. Okay, this comes from here, the amount. So what you're going to be expected to do, okay, Joshua, you have to be able to figure out what the flow of cost was. Okay, you'd have to figure out, okay, we began the inventory, we began the year with this amount of inventory in materials, work in process, finished goods. This was the activity. The further debits are the activity in those three inventory accounts. Okay, and then you'd have to know that it flows from the work in process inventory to the finished goods inventory. And then finally, only when the goods are sold, that's when the cost of the goods sold is debited and finished goods are credited. Okay, so Joshua, if I asked you what were the ending balances of the three inventory accounts, and it doesn't have to be Joshua, if I asked you for the balance sheet that we're going to prepare after this, what were the balances that for the three inventory accounts that were going to appear on the balance sheet at the end of this year? Okay, what were the balances in the inventory, the three inventory accounts at the end of this year? Could you tell me? Anyone? Okay, what was the ending balance that's going to appear on the balance sheet for the direct materials inventory? Okay, yes, very good. First, let's do direct materials inventory. It was $20,000. That's the balance sheet amount at the end of this year for raw materials inventory. Okay, and yes, for the work in process inventory, Joshua, very good. The work in process inventory account is going to have an ending balance of $40,000. Excellent. Okay, and then here, the ending balance in the finished goods inventory account is going to equal $168,000. Yes. Okay, and now once we've gone through all these journal entries and what the flow of cost is, you are really responsible for knowing all of this. Okay, we're going to go over a lot of examples, but again, once you understand the concept, it's just repetitive. It's always a flow of cost. The three product costs, direct materials, direct labor, and manufacturing overhead, they all get applied to the work in process inventory. And then finally, when the goods are completed, they get transferred to the finished goods inventory account. And then once the goods are sold, they get transferred to the cost of goods sold. Okay. Okay, very logical. All right. And remember the beginning inventory, like the $25,000 of materials inventory, that's always going to be given. The $30,000 of work in process inventory is going to be given. Okay, and you'd be able to just do the journal entries. You'd have to be given the dollar values, yes. And then you'd have to figure out, okay, what does it mean? what do those debits and credits to the ledger accounts, what do they actually mean? And what's the normal flow? Okay, good. Okay. Again, very different when we're looking at manufacturers. Okay, so remember, okay, and there's a lot of review in this chapter. Okay, so I promise you'll walk away really understanding this. And some of you are going to be interested in this. I always found cost accounting very interesting. Okay, so direct materials. Again, if we see you on campus, I would see that we're walking around mumbling. All right, direct materials. We know that they are a product cost. Okay, we also know that direct materials are a prime cost as well, right? A product cost and a prime cost. Okay, remember direct materials are the raw materials that become, and component parts. So and again, I can actually trace with my eyes, I can actually see the direct materials going into the production. So for a bike, what would some of the raw materials that I would be charging to the work in process account? Brakes, shifting gears, the pedals, the sprocket, the tires, I guess the aluminum, whatever bicycles are made out of right now. Oh, here, alloy tubing for the frame of the bicycles. Those are considered direct materials because I can quantify and I can see them going directly into the production. So they are charged to direct labor. They're charged to direct materials, and then those costs are going to be debited to work in process inventory. Okay, and here just to remind you of that journal entry. Again, when they're placed into production, debit the work in process inventory account for whatever that dollar value is, and then you're going to credit the direct materials inventory account. Okay, so this is the journal entry to apply direct materials into production, into the work in process. All right, the next type of cost is indirect materials. Oops. And I want you to remember indirect materials, okay, what are they part of? They're part of manufacturing overhead. Okay, direct materials get charged to manufacturing overhead. Again, indirect materials are materials that are used in the production process, but they're not a major component. So I can't actually track it going into work in process. Okay, and typically the cost is not significant enough that I'm not going to want to know the exact amount of indirect materials going into production. So what are some indirect materials? Let's say like bearing, like grease, oil that goes into the wheels, whatever, on a bicycle. Welding materials, when they weld together the different parts of the bike. Maybe cleaning compounds at the end after manufacture. The costs of these items are not significant enough. I'm not going to track them, okay, for each unit produced. Okay, so what am I going to do here when I record indirect materials, okay, being applied to production? What I'm going to do, I'm just going to debit the and you'd have to be told what the dollar amounts are. I would debit the manufacturing overhead. Remember, because manufacturing overhead always gets debited for the actual expense. So manufacturing overhead, it would be debited, and then which account gets credited? It would just be a payable. It would just be various accounts payable. Okay, for the stuff that I bought, the oil, the grease, all that interesting stuff. Whoever I have to pay for that, that would just be the accounts payable. Okay, for the bearing grease. I'm not going to bother tracking the cost for all of those individually and making it part of the work in process. I'm just going to charge it to production through the manufacturing overhead account. Is manufacturing overhead, though, is that a product cost? Is manufacturing overhead a product cost? Who remembers? Potential exam question. Is manufacturing overhead considered a product cost? Hello? Anyone? Yes, very good, Kristen. Very good, Casey. Oh, no, it is actually, remember, 3 product costs, direct materials, direct labor, and manufacturing overhead. So the answer is yes. Okay, so here, I'm not going to track it through the direct materials because it's not significant enough, but I'm going to charge it to another product cost account, which is the manufacturing overhead account. Okay. All right. Another cost in production is, okay, so how do the direct material costs, how do they get tracked through the general ledger system? Remember, the cost of direct materials are debited. Okay, now this is going back to direct materials. The major components, the cost of direct materials are always debited to the materials inventory account. That's what we saw earlier on that flow chart. And then as the materials are placed into production, okay, remember that journal entry that I did, as direct materials are placed into production, I am going to debit the work in process account for that dollar value, and I'm going to credit the direct materials inventory account. Direct material inventory account for whatever that dollar value is. Okay, and then remember, when you have direct materials, it's an inventory account, so there's always going to be a beginning balance and an ending balance. Okay, so the balance in the materials inventory at year end, okay, that is going to equal the amount that's the ending balance of direct materials. That's the amount that's going to appear as your direct materials inventory account on the balance sheet at year end. Okay, that's the normal flow. Just like we had inventory, remember, for merchandisers, we had an inventory account, and then we would always have the ending inventory for the finished goods would be the, at the end of the year, that would be the amount appearing on the balance sheet as direct materials at the end of the year. Okay. Now, direct labor, again, direct labor is a product cost, right? It is one of the 3 product costs. Direct labor is also considered a prime cost. These are all great definitions. Direct labor is also considered a prime cost. Direct labor, right, is also even considered a conversion cost. Okay, so these are, and again, for analysis purposes, direct labor is a component of each of these. Okay, remember, direct labor includes employees who work directly on the assembly line. Okay, and remember that they have to be sitting in the warehouse, I'm sorry, in the factory. Okay, they're sitting in the actual factory. So, and they have an hourly wage. Direct labor always is paid an hourly wage. Always, always, always. So if you see anybody on a salary basis, you know that they are not going to be included in direct labor. Exactly. Not management, Kristen, not supervisors, exactly. Okay, not quality inspectors, because again, they're all on a salary basis. Okay, it's only people who get paid hourly wages that's considered direct labor. So who typically by title is going to be a direct laborer? Cutters, you know, when they cut for the bicycle company, they cut the tubing. Welders, you know, welders are people who, you know, basically melt and put together the bicycles so that they stay together. Painters, okay, and again, painters of like the, whether it's robotically or by hand. Assemblers, you know, like I Love Lucy, standing on the assembly line, putting the dough for the cookie, then putting the chocolate chips into the cookie, and then putting it into the oven and whatever. They're all assembly line people, so they would be considered direct labor. And then finally, even the packers, even the people who put it into packaging. Okay, here the partially assembled bicycles. Okay, because they're adding something to the final product. Okay, they would be considered direct labor. Okay. Oh, and here, I'm sorry. And then just as a reminder, when direct labor is put into production, when the direct labor costs are applied to production, it's always going to be a debit to the work in process inventory account and a credit to the direct labor account. Okay. Who's the journal entry? All right, and then indirect labor. All right, so what is indirect labor again? Again, so many employees in a manufacturing plant don't work directly on the goods manufactured. They're not assembly line workers. Okay, so you still have a lot of people who don't work, who don't directly affect the product being produced. So those individuals, again, are considered indirect labor. Okay, anybody who doesn't directly touch the final product, and they're included in manufacturing overhead. So indirect labor, okay, gets charged to manufacturing overhead. All right, so what are some examples of manufacturing, of indirect labor? Any factory supervisor, okay, any maintenance personnel, again, but they have to be in the factory. Maintenance personnel for anybody, you know, for the administrative office building, they're not indirect labor. Maintenance personnel in the factory, forklift drivers who are sitting in the factory, okay, and only, remember, security guards in the factory, okay, not everybody. Remember that in order to be a product cost, the cost has to be incurred in the factory. So a security guard who's in a factory, yes, you are going to, for their salary, okay, you're going to debit the manufacturing overhead account. Okay, manufacturing overhead. And then for the factory security guard, you're going to credit wages payable. Okay, for the factory security guards. But now, how about the security guard who's sitting in the executive's offices? Okay, where does the salary for a security guard who's sitting in the executive offices? Where am I going to see that person's salary being charged to? Is going to be a product cost? Security guard in the administrative offices? No, Kristen. Where are we going to see that expense being charged to? Remember, it's not a product cost, a period cost. Excellent, Christian. Excellent, Daniel. It's going to be charged to no. If it's a security guard in the administrative offices, remember their salary is charged to a period cost or to the operating expenses. Okay, so their salary is going to be deducted from the gross profit. Okay, so here we're talking about all product costs. Okay, but if they're sitting in the administrative, just like the chairman's salary, the secretarial staff, all of those administrative costs, they are going to be deducted after gross margin. They're not considered part of cost of goods sold. Okay, really important definition. All right, good. And then indirect labor, again, So indirect labor, the services of people who are paid, services of employees who are, okay, so here, indirect labor, remember indirect labor basically are those individuals, okay, who their salaries get charged, indirect labor is charged to manufacturing overhead, okay. But remember when I showed you the general ledger earlier for the direct labor account. Remember when we were discussing the direct labor general ledger account? Basically, anytime a payroll is paid for direct labor, okay, it is going to be debited. Okay, the direct labor account is going to be debited for the payroll each cycle. Okay? Each cycle. All right. And then when does the direct labor account, when is it going to be credited? The direct labor account is going to be credited whenever the direct labor is applied to the work in process. Okay. So is it possible, okay, and we saw that actually in the earlier example, is it possible to have a credit balance in the direct labor expense account? And remember, the answer was yes. Okay, it could just so happen that we're in between pay cycles, okay, and the employees are not going to be paid until maybe early the next month. Okay, but remember, we're preparing our financial statements at the end of this month. Okay, so it may be that the credits, okay, the applied direct labor is greater than the amount that was paid for direct labor based on the payroll. So it's not unusual to have a credit balance at the end of the month in the direct labor account. Okay, but again, where would we see this direct labor account appearing on the balance sheet? Anybody remember? If the credits in the direct labor account are greater than the debits, where would we see that credit balance appearing on the balance sheet? Okay, under wages payable, right? Because that means at the next pay cycle, we know the corporation's going to pay off their wages payable. Okay, everybody good? Everybody, that's clear? Even though direct labor is an expense account, you can have a temporary credit balance in it because of the fact that it's just more labor has been applied to the work in process. And this, again, is going to change when the next pay cycle comes about in early the next period. Okay. All right. I know a lot of new concepts here. That's why it's so interesting. That was where you were going to use, right? Again, this may be your specialty one day, so who knows? You just never say never, okay, when it comes to potential career choices, etc. Okay, who knows where you're going to end up at this point, right? It's going to be something different than what you originally planned, so you have to be prepared. All right, so manufacturing overhead. Remember that when you hear those words, manufacturing overhead, you're going to immediately say that, yes, it is a product cost. Okay, and remember that your mantra, if you were walking across campus and I saw you, you would be mumbling to yourselves, I know there are 3 product costs. If this cost is incurred in a factory setting, I know it's either going to be direct labor. If it's a direct labor cost, it's going to be part of direct materials. If it's not a direct material cost, then I know it has to be manufacturing overhead. Okay, and manufacturing overhead, all those indirect costs, which are not direct labor or direct material, are going to be debited to manufacturing overhead as long as they're incurred in the factory. Okay, and again, there's a lot of little accounts that make up manufacturing overhead. Is the control account, okay, and then you're going to have a bunch of other subsidiary accounts. And also, or always remember that for the general ledger or T account of manufacturing overhead is always debited for the actual indirect expenses, right? Okay, the actual expenses in manufacturing overhead get debited, and then when those manufacturing costs are applied, okay, when those manufacturing costs are applied to the work in process inventory account, you know you are always going to credit your work in process, your manufacturing overhead in your manufacturing overhead account. Okay, so actual overhead expenses get debited to manufacturing overhead, and once that overhead is applied to work in process, you're going to credit the manufacturing overhead account. Okay, another thing I'm going to mention to you is that this manufacturing overhead account, you always want at the end of the year, the corporation always wants its manufacturing overhead account balance to be zero at the end of the year. Okay, because any of those expenses you incurred, all those indirect costs, because remember in manufacturing overhead, all indirect costs in the factory get charged to manufacturing overhead, right? All the direct costs, like direct materials, direct labor, they're charged to those accounts, but manufacturing overhead is an indirect cost. It is a product cost, but it's also an indirect cost. Okay, and a company always ensures that its manufacturing overhead accounts at the end of the year equals zero. And we'll see how they do that in the future, just to introduce it here. Okay, everybody good? Okay, again, some examples of, because it's so, it's such a big, remember, the manufacturing overhead is going to be the largest of all of the product costs. Okay, manufacturing overhead is always going to be the largest of all product costs, the balance in that account, because it incorporates everything except direct labor and direct materials. Okay, so my handwriting with this. Okay, next time I'll type it out. Manufacturing overhead is the largest of all of the manufacturing of all the product costs. Okay, and again, some of the costs to just to give a little more detail, some of the expenses that get debited to manufacturing overhead, again, it gets incurred in the factory. Some of them are indirect material costs, and again, that's like the glue or the grease, right? Any of those things. Again, it's a material, but it's indirect because the cost is so low. Any indirect labor costs that are incurred in the factory, such as supervisory costs, right? Quality inspectors, okay? Any plant occupancy costs. So basically, if you have factory depreciation expense, factory rent, okay, those are all going to be, those are all expenses which are going to be debited to the manufacturing overhead account. Machinery and equipment costs can also, and that's part of factory depreciation, they would be debited to manufacturing overhead, and the cost of any regulatory compliance like OSHA. That's basically a government agency that's responsible for employee safety. Anything that a corporation has to abide by, okay, like wearing helmets, wearing, coveralls to protect, your skin or whatever. In a warehouse, all of the costs for those items are going to be included as manufacturing overhead. And again, you just repeat to yourself, okay, it's not direct labor, it's not direct materials, boom, has to be manufacturing overhead. Okay, it's that clear cut. Okay, and again, manufacturing overhead, again, Joshua, so indirect materials are typically, yeah, and that's exactly why, remember, indirect materials, typically, what are they? They're going to be like the grease that you use or the glue. It's going to be amounts, are going to be values that are typically low, right, in dollar value. So you don't want to track, okay, how much glue did I use on that particular on that particular bicycle to keep it together? How much grease did I put on the gears in order to? So yes, indirect material costs individually are going to be lower. So it's not worth tracking. And also the quantity you use are going to be lower. So the cost then is lower, yes. And that's why they're charged directly to manufacturing overhead. Okay. And again, as I mentioned earlier, over the course of the year, okay, over the course of the year, when you're thinking about manufacturing overhead, again, all of the actual costs, okay, are debited to the manufacturing overhead. And remember, applied costs are credited to manufacturing overhead. Okay, So and then here, as I was mentioning earlier, at the end of the year, you want the manufacturing overhead account balance to equal 0, so that all of your costs that have been applied to production, okay, have been applied, all of your manufacturing overhead has been basically applied to production. All right, so if I asked you, so if I asked you, you know that there are 3 product cost accounts. The 3 product cost accounts are direct materials, direct materials is a product cost account. Direct labor is a product cost account. Okay, and of course, you know, we've gone over it so many times. Manufacturing overhead is also a product cost. Okay. But at the end of the year, which of these 3 product costs are typically going to have a 0 balance? Only manufacturing overhead has a 0 balance at year end. Only the manufacturing overhead account has a 0 balance at year end. All the others are permanent accounts, has a 0 balance. The other product cost accounts like direct materials and direct labor are always going to have ending balances in them, okay, because they're actually carried forward into the next year. But manufacturing overhead must be applied to production in the year it's incurred. Okay, so manufacturing overhead always has to be applied to the units produced that particular year. So at year end, it's going to have a 0 balance in that account. Okay. All right. Again, I mentioned this earlier, but just for definitions, okay, when we're talking about direct manufacturing costs, okay, which costs are direct manufacturing costs or direct product costs? Direct product costs, they have the word direct in them, direct materials, direct labor. There's only one indirect manufacturing cost, okay, and another word is an indirect product cost. The only indirect product cost is manufacturing overhead, because it's that whole pool, right? I know exactly how I can trace how much direct material goes into each product, how much direct labor is applied to each product I produce. But manufacturing overhead is made up of all of these smaller expenses, so it has to be considered an indirect manufacturing costs. Okay, so how do I charge manufacturing to the units produced? And we're going to talk about this next chapter. There has to be a way of allocating. Okay, so a company has to decide before it begins operations, how are they going to allocate manufacturing overhead to their production? Okay, again, direct material and direct labor, you can just track easily. You can sit there and see, okay, I see how much goes into production. Manufacturing overhead must be allocated over the course of the year, and Chapter 17 is all about that. Okay. Work in process, remember work in process inventory, that's one of the 3 inventory accounts. Okay, work in process inventory is one of the 3 inventory accounts, and again, it gets debited for all the accumulation of manufacturing costs incurred over this year. Okay, and then once those units have been completed production, okay, you're going to then transfer the cost to the finished goods inventory. Okay, remember that also the work in process inventory is typically going to have a beginning balance also, because that's the amount of finished goods on hand at the end of the previous year. Okay, and remember, okay, it becomes nature. It should be starting at this point when the units are completed. Okay, and now the units are completed production. We can't keep those units in our work in process inventory account. What is the journal entry to transfer the costs of the finished goods? The finished goods inventory account is going to be debited. the finished goods inventory account is debited whenever the work has been completed, and then which account is going to be credited. Okay, once the goods have been completed, you're going to credit the work in process inventory. That is the normal flow of costs in a production, in a factory. Once the goods are completed, you reduce the amount of the work in process inventory and debit the amount of finished goods inventory. Okay, and again, once the finished goods have been sold, okay, what's the journal entry? Once the finished goods, only when they're sold. Remember, until the units are sold, all the cost of all those goods are sitting in the finished goods inventory account. Only when they're sold, that's when you're going to see the finished goods inventory account being debited. Not debited, credited. What are you saying? Finished goods inventory account is being credited, and which account gets debited? It's an income statement account. Which account is going to be debited when the goods are sold? Excellent, Daniel. Cost of goods sold. Okay, until they're sold, though, they're sitting in that inventory account. Goods inventory, very good. Okay, and again, remember that once the goods have been completed and they're sitting in the finished goods warehouse, okay, no additional costs are going to be allocated to them. Okay, because they're finished. All those bicycles are done. They're completed production. They're waiting for the point of sale. Okay, so remember, for the warehouse, any factory cost, any warehouse costs. Okay, any warehouse costs for storing finished goods. Okay, any warehousing costs. Okay, or any warehousing cost for finished goods. Okay, do not add to the value. Okay, so those are all considered selling costs. Okay. So the cost, like let's say the depreciation for the finished goods warehouse, the security cost for a finished goods warehouse, okay, they're not product costs. Okay, nothing is being added to that inventory, so they're considered selling costs. And again, that means they are deducted on the income statement after the gross margin. Okay, they're deducted from selling expenses after the gross margin. They don't flow through the cost of goods sold. Okay. Good. All right. Don't worry about that. Let's see. All right. You know what? I think we completed enough for today. Go through those journal entries. Make sure you understand them. Okay, because next class we're going to start on Tuesday. We're going to, oh no, we have, that's fine. We don't have we have a midterm next week. All right, so actually, let's continue going for 10 more minutes. Sorry, guys. Okay, because I just want to make sure we complete chapter 16. All right, so and then we'll do for chapter 16, whatever we don't finish today, we will finish on Tuesday, and then I'll do a review, okay, what you can expect for the midterm next Thursday. Okay, all right, so we've been doing all of our journal entries over the course of the year. Okay, so now we want to figure out what our cost of goods sold are. Okay, if it's year end and we want to figure out what our cost of goods sold are. Okay, we don't have just one general ledger account. Okay, for figuring out our cost of goods sold. What do we have to get together? We have to create some support documentation at the end of the year. At the end of the year, some support statements. Okay, so what are we going to do? We're going to before we figure out what the cost of goods sold are, we have to figure out what the total costs of finished goods manufactured are. Okay, so before cost of goods sold is determined, we have to determine the cost of the finished goods manufactured. Okay, so again, whenever we're determining what the finished goods manufactured are, we're always going to start out, we have to figure out how much was placed into production this year. Okay, so how much in terms of costs were placed into production this year? Again, we always start with the work in process inventory. We know we started our work in process inventory account this year. Again, this was the balance of the work in process account at the end of last year. Okay, we have a $30,000 balance in work in process inventory at the beginning of this year. All right, then what did we add to production this year? Okay, and again, we can get it from those journal entries we just completed. We know what are the product costs, direct labor used, direct labor applied, direct material used, and manufacturing overhead. Okay, all of those three costs were applied to the work in process inventory account over the course of this year. Okay, so the total of those costs, the $810,000 in product cost this year, plus the amount of work in process we began with at the beginning of this year, added together, they equal $840,000. So $840,000 of goods were sitting in our work in process inventory account over this year. Okay, but what else do we know? We know that when we did our physical inventory count at the end of this year, okay, when we did our physical count of inventory of work in process, we know that we have $40,000 worth of work in process inventory at the end of this year. Okay, so what can we tell from that? We know that this is what we started with, this is what we added, okay, and this is how much we have in work in process at the end of the year. So what does that tell us? That tells us that $800,000 worth of inventory was completed this year. Okay, $800,000 worth of inventory was completed this year. Okay, so what does that mean? $800,000 worth of inventory was added to the finished goods inventory this year. Okay, 800,000. Again, we got this from the previous schedule. So here, to figure out what the cost of goods sold is, okay, what am I going to do? I'm going to start now with the beginning finished goods inventory. Again, and I get this from my balance sheet account at the beginning of the year. I started out the year with $150,000 worth of finished goods. I added, okay, $800,000 worth of finished goods to my inventory this year. I just saw that in the earlier schedule, right? When I looked at the work in process account. All right, so those two amounts added together equal $950,000. Okay, when I did my physical count now, and this is the physical count of finished goods. Okay, my count of finished goods at the end of the year equals $168,000 worth of inventory. So this is what I began with. This is everything that was added over the course of the year to finished goods. This is how much I still have at year end. So what does that tell me? That tells me that my cost of goods sold for this year equals $782,000. Okay, so when you do your support schedules at the end of the year, the first thing you're going to figure out is your cost of goods manufactured. Okay, and here you start with the work in process at the beginning. You look at all the work in process added. Okay, you come up with a total of the work in process. You subtract out what's still on hand in work in process, and that tells you the cost of the finished goods manufactured. Okay, that's the amount that was transferred to the finished goods inventory account for this year. Okay, now to figure out cost of goods sold, you add what the beginning balance in your finished goods inventory account is. You add the finished goods that were transferred here to this inventory account over the course of the year, and that gives you the cost of finished goods available. Okay, then you subtract out your finished goods inventory at the end of this year, and that will tell you then what the cost of goods sold were for this year. So those two, for a manufacturer, those two schedules have to be completed. Okay, and it's just looking at the changes in work in process inventory and finished goods inventory. Okay, always the same. All right, now once you figured out your cost of goods sold, now what do? You can now put together your income statement. All right, so you know how much you sold this year, the 1,000,003. Okay, you get that from the general ledger account. You figure it out now from the previous schedule what your cost of goods sold was, 782,000. Okay. So you sold, I'm sorry, the cost of goods sold, yes, you sold $782,000 worth of inventory. So what is your gross profit? Your gross profit just from selling your inventory was $518,000. Okay, after the gross profit now, you have to subtract all of your selling and administrative expenses. And again, you'd have to be told this. Okay. So when you subtract out your selling and administrative expenses, they equal $400,000. You subtract the $400,000 operating expenses from your gross margin, and what does that tell you? Your income from operations is $118,000. Your interest expense is $18,000. Okay, so that means that your income before taxes equals $100,000, and then just subtract that expense, your income tax expense, and ta-da, from this you are able to figure out what your net income for this year is. Okay, so again, you have to figure out your cost of goods sold, and then now you can prepare your income statement. Okay, remember, okay, after you have your income statement, that's always the first financial statement prepared at the end of the year. After the income statement, now you can prepare your balance sheet. Okay, and remember, your balance sheet always just lists first your cash accounts. Okay, then your accounts receivable. Again, for us, you would maybe have the available, the marketable securities, right? We learned about that earlier this semester. And then after that, you have the three inventory accounts, the ending balances in those three inventory accounts, which are going to be added together, and they equal 228,000. So what are the total assets of this corporation? $478,000. Okay. And again, these are what you determine the ending balances in. Okay, so $20,000 in materials, $40,000 in work in process, $168,000 in finished goods. And remember, that was from the general ledger analysis we did earlier. Okay, that's the ending balances. And that's it. Okay, so please, guys, make sure you read this chapter. Make sure next class we're going to go over the exercises for this chapter. I posted them on. I posted the solution here at the end of this Blackboard Collaborate, and also I posted it on the materials for this particular class as well. So we'll start with the exercises for chapter 16, and then we'll do a review on Tuesday and possibly start chapter 17. Okay? So everybody have a good weekend. Stay healthy, stay happy. Okay? And I will see you then on Tuesday. Okay? It's an important class, okay? Because we have our review. All right? So everybody have a good weekend. Can you please check the settings? Yes, I will. Joshua, I'll look absolutely early tonight just to make sure. Okay? Oh, you're welcome, Menpreet. Have a good weekend. Christian, have a good weekend. Stay healthy, guys. Okay, this is going to be a